Live from Sydney, this is Insight with me, Heidi Stroud-Watts, where we dive deeper into the stories that matter with crucial context and sharp analysis. While top story in China's central bank is suspending buying government bonds in its latest attempt to prop up the yuan and boost business and consumer confidence. Asian stocks and US futures are slipping as caution takes hold ahead of the US jobs report and more Fed voices signalling rates may stay on hold for longer. Plus, TCS profit and revenue fall short of analyst estimates, but the company is optimistic about a better year ahead. Find out why when we speak exclusively with the CEO. Let's get you straight to Asian markets. And of course, so much of the focus over the past hour or so has just been what we've heard from the PBOC saying it will temporarily halt buying of government bonds. And of course, so much of this is really down to the fact that they don't want this to be sort of a one-way bet situation, right, from investor expectations that have really heavily been betting on the ongoing economic weakness and the weakness that we continue to see in the yuan. So we could see some support when it comes to the Chinese currency. This suspension expected to give cause to higher bond yields as well. But this is a picture as we look across the Asia Pacific. Stocks really slipping ahead of also a bit of data uncertainty out of the US as well. We're watching that key jobs number, particularly in light of the growing chorus of caution that we're hearing from Fed speakers as well. You can see it there that China yields have really jumped after the PBOC said that it would be suspending bond buying. Elsewhere around the region, shares in Japan and Australia also slipping. Those in Hong Kong had been sort of sitting a little bit higher, but of course there is just that broader sense of trepidation. One stock that we are watching when it comes to Hong Kong is, of course, we've had quite a bit of exuberance over a number of debuts, in particular when it comes to the toy space. The Ultraman and Transformer toy maker blocks jumping 82% in the Hong Kong session after what could be characterised as quite a frenzy over that IPO. $215 million initial public offering there. We're seeing a jump of over 80% in that debut, opening at over $109 Hong Kong compared with the IPO price of $60.35. Individual investors thousands of times higher in that demand from the number of shares that were reserved for them. All right, we are just getting some breaking news when it comes to the political kind of landscape that we continue to watch. And we've been watching, of course, the situation when it comes to Canada and the number of people that are in that leadership race for the Liberals. We're hearing from Krista Freeland that she may enter the leadership race next week. That's according to reporting from the Globe. Let's get some more now when it comes to the latest developments out of China. Grace Tam, Chief Investment Advisor at BNP Paribas Wealth Management Hong Kong. She expects additional monetary and fiscal stimulus this year. I also want to bring in Garfield Reynolds, who leads our Markets Live Asia coverage, with us here as well. And, you know, Garth, I will actually start off with you because it's interesting. We know that the PBOC, we know that authorities in China don't like a one-way bet of any type. Well, you know, to be fair, neither do other central banks and authorities, right? So what do you make of these developments?
Well, you know, it's part of the PBOC is very, very obviously getting the House in order before Donald Trump takes over the presidency in a week and a half's time, precisely because investors themselves are very anxious about what that might lead to, and China, it's no secret to them that Donald Trump has certain concerns with some of China's policies and a willingness to use tariffs and potentially who knows what else in order to try and correct those. So with that, there's plenty of pressure. There's been, to some extent, some front running when it comes to the yuan in particular, but also even when it comes to Chinese stocks and therefore Chinese bonds. So the PBOC wants to make it clear it's not willing to just sit back and let the yuan slide and let bond yields slide without any limits. It's imposing some limits. It's putting up stop signs, and traders today have taken some notice of that. The bigger concern for the PBOC is that unless, in particular, the authorities in Beijing can persuade investors that they are able to turn the Chinese economy around in a sustainable fashion, that downward path for the yuan and for yields will remain there, and these actions by the central bank will just end up offering traders and investors more attractive entry points for trades which at the moment make a fair bit of fundamental sense.
Grace, I wanted to get your weigh in on this as well in terms of this latest suspension that we've seen from the PBOC.
It's quite obvious that China, they still want the stabilities in terms of the currency. They actually, as you know, managing financial risk is actually one of their priorities. And in terms of the temporary halting the bond buying, as you know, last year they already have some verbal warning to brokers, to regional banks. You have to stop bond buying, because I think they're really worried about the leverage positions building up, and in case yields rises, as you can see, you can imagine the unwinding the problems, and so I think for this time, especially when they are continue seeing the renminbi depreciations, they wanted to stabilize a bit, and this is actually one of the ways that could squeeze the domestic liquidity, and hopefully to see some rebound in terms of the yields, and that will actually narrow the gaps. Especially the yields gap between the U.S. and the yuan, and that could defend the stabilization of the renminbi.
We've spent a lot of time this week talking about, the fact that we have seen, particularly not just now producer price inflation, but the pretty dire outlook when it comes to consumer inflation as well in China. Do you think this sort of talk about the Japanification of China's economy, that is meaningfully changed in terms of an argument, because it does feel like the medium and longer term growth expectations have really shifted lower?
Yeah, I think there is a lot of talk about especially worried about the deflation risk in China, but as you can see, especially from late last year, there's officially change in terms of the monetary policy stance. It's after 30 years using prudent monetary policies, they now change to moderately loosening. So this is actually a big change, and you will anticipate. With the stance changes, we're going to see more easing policies these years, and of course the markets will want to see not only monetary easing but also more on the fiscal easing. We also see, for example, this year's fiscal deficit could increase to 4% of GDP. So although that's not really a bazooka, but we're still thinking there could be more stimulus, especially I think we should watch very closely in March the NPC meetings, and to see if they're going to do more. To actually support the economy.
The PBOC, no doubt, Garth, is in a tough spot, right? But when you take a look at a move and a decision and announcement like this, how much does it potentially deter, in particular, foreign investors from wanting to touch that space, despite, of course, that being one of the ambitions for the Chinese markets and authorities?
Oh, there is a key concern, precisely because, if you look at even when we had the equities, big bazooka announcement, as some people called it, where the stimulus came in late September and equities soared, lots of people bought in. Since then, they've really struggled to hold on to that peak, precisely because what the authorities say and what they end up doing, there's a gap, and you're never quite sure when they're going to decide that XYZ your move in markets or in society has gone too far, and they need to throw up a stop sign or reverse matters, and that makes foreign investors in particular nervous. The other concern, of course, when you're comparing China with the rest of the world is, well, you look at the way that US equities keep on going up and up, and you think, well, why am I going to go into China when I can go into the US or potentially into other developed markets, which mostly seem to be freer, easier to get into and out of, and also more likely to rise in a low volatile fashion. So that's got to be a concern for the PBOC and for the Chinese authorities, is all of these tweaks that they're doing across the various asset classes. One of the things that does is guarantee volatility, although then again, US assets also face their own volatility storm this year.
Do these just act as sort of circuit breakers at best, right? Because it's hard to see a convincing argument for a recovery in the yuan, a stability returning if there is no kind of longer-term economic fundamental turnaround that creates less of a gap between the US economy and US policy.
Yes, there is that. However, it's kind of the only thing that the PBOC in particular can do. They are, as it were, fighting a rearguard action precisely because I don't think anybody should make the mistake of thinking that the Chinese government is not seriously committed to attempting to turn the economy around. It is, however, a very gradual process. It's always going to be potentially a gradual process to turn around such a large economy, and a large economy that is built around command and control characteristics rather than necessarily free market laissez-faire theory. So in that situation, the PBOC wants to make sure that not too much damage happens on the road to what it would expect is a more sustainable economic turnaround over the long term. They perhaps understand that both local and foreign investors don't have as much patience as the Chinese government, so they'll help to force them into being a bit more patient than they otherwise would be.
Grace, do you think we'll have to sort of exercise patience when it comes to expectations for more stimulus, particularly on the monetary side, if there is so much pressure to not have the currency weaken further?
Yeah, I think for markets, market always wanted to see China coming to a point of whatever it takes, but obviously for now it's not. But I think there's certain things, especially from late last year's, as I said, the change in monetary policy stance with more monetary measure. Especially they also have measures to support the stock market. So it looks like they don't want to see especially the continued downside in the stock market. They want to see some slow and healthy bull market, because that could be the wealth effects and support investors with more consumption, etc. But I think for now, obviously, since early this year, given the geopolitical tensions, as you know, the Chinese market actually went down instead of going up as we wish, and I think it could signal that more could be done in the near futures. Especially, I think the Chinese authorities they are still having a pro-growth stance. Obviously, we're not saying we're going to see a V-shaped rebound in terms of the economic momentums or especially the property sectors, but at least I think they would want it to stabilize the economy, especially with the potential negative impacts on tariff, etc., and a lot of policy uncertainties from the U.S. I think they still wanted to stabilize growth. They wanted to stabilize the financial risk. So, and that's why we have the measures to stabilize the yuan and as well as the bond markets.
Both you and Garth have really talked about the potential for higher volatility this year, and that pertains to the US market as well, right? You guys are still overweight US equities, but you really kind of underscore the need for diversification. Is that because you see a lot of these Trump trades or Trump sort of tariff-related themes having already played out?
Yeah, Actually, we actually continue to see U.S. equities. Obviously, the momentums could go on for a while, and especially I think for over past 1-2 years, a lot of focus is on the Max 7. But now, actually, for other sectors, we're seeing, especially in terms of the earnings growth estimates, actually the gap versus the Max 7 actually has been closing. So we actually continue to see catch up for other sectors, including the small mid caps in the U.S. Equities market. But having said that, of course, we've already seen a lot of, as you mentioned, Trump trades playing out, a lot of inflows into the U.S. Equity market is getting more crowded. So we also have some worries in terms of, especially if there is any changes in terms of the inflation outlook, and then especially the Fed's outlook. Instead of cutting, it changed into hiking. I think that could be a surprise to market, and it's not priced in. seen. So obviously that could trigger like corrections in the market, and so diversification this year is also one of our key investment themes. We wanted our investors, our clients to apart from looking at U.S. equities, also look at like other asset classes, and including like hedge funds or have positions on gold.
Garth, there's already that division between the sort of Fed assumptions versus where traders see the amount of easing, and there's certainly a party that thinks that possibly inflationary pressures will get out of control and there would need to be further tightening from the Fed. Do you think we might end the year quite different to where these expectations are being set right now?
Well, I think that's in many ways the most likely outcome. We're reminiscent of last year as well, where there's a very strong expectation coming into 2024 that the Fed was about to break the economy, and so it was going to switch to very rapid easing. Instead, although the Fed ended up cutting rates by about as much as it had signaled it would, it didn't start until much later than even it thought, and certainly much later than the market thought, and that caused plenty of volatility as it was, even though we had the AI boom to drive equities up, in the face of that. So when you look at what we're coming into this year, there's an overwhelming expectation that US equities will finish higher. There's also plenty of optimism that bond yields will finish lower. I would argue one of those two things is likely to not be the case. If we do get a very strong equities rally, I would think the chances are that bond yields stay about where they are by the end of the year or go higher. And on the inverse, if the people who have been so worried for so long, and at times I've been one of them, by the overvaluations implicit in the endless and relentless climb in US equities, then that would bring equities down, and it would bring bond yields, I think, down further than most people expect.
Grace, is the Fed your sort of one big risk for this year as well?
Yeah, obviously. I think especially for reason concern in terms of the inflation rates that could potentially bring by Trump's potential policies. I think that's actually number one concerns, especially for now. Markets still pricing in a slower pace of cut, actually 1 to 2. Our base case is 2 cuts this year. But I mean, especially if we are seeing numbers on CPIs or other inflation indicators, seeing any kinds of pickups in terms of inflation, and that will see obviously market adjust their outlook in terms of the rate hike probably. And for now, actually, nobody's actually pricing in any rate hike anytime soon. But that's of course that could be a risk. Yeah.
Grace, really great to have you with us. Grace Tam of BNP Paribas Wealth Management in Hong Kong, and MLive's Garfield Reynolds here in Sydney as well. Still ahead this hour, we'll be speaking exclusively with the CEO of India's Tata Consultancy Services after the IT giant missed estimates on both revenue and profit. This is Bloomberg. Well, UK Chancellor Reeves visits China this weekend in a bid to deepen economic ties. She would be the most senior British official to visit Beijing in 7 years. Let's bring in Jill Desis, who's our Bloomberg News desk editor, for more. So, Jill, what do we sort of know about the framework of this visit and what we could see?
Well, look, Heidi, this is a fairly critical visit just because, as you mentioned, this is the first time in some 7 years that the UK has, sent someone of this level to Beijing to sort of work through, whatever that may mean in terms of establishing better bilateral relations there. You're looking at potentially sort of lessening trade tensions, diplomatic tensions between these two nations. I should also point out that with Reeves' visit, I mean, this is also the first time in quite a while that the UK has really had a Labour administration here. So, obviously prior to that, we saw tensions really ratchet up between the UK and China under the Tories. You last saw Theresa May, actually, I think was the last Prime Minister really visit, that sort of level. So with the Chancellor Reeves coming in, what she's expected to do is meet with her essentially her counterpart in China, He Lifeng. They're expected to sort of talk through some bilateral ties. Maybe there's some conversations that they can have there about capital markets between these two nations. But ultimately, it's also kind of an interesting meeting just because there's some opposition to this meeting on the UK side from the Conservatives. So there's some tension sort of surrounding this particular meeting. But it will be interesting to see, particularly when everybody's paying attention to what's going to happen in the United States with incoming President-elect Donald Trump, how exactly the UK and Beijing ultimately try to foster relations here.
And obviously another key relationship we're watching is US-China, and we're hearing that Xi Jinping is just then at a top-level envoy to the Trump inauguration.
Yeah, Heidi, this is a really interesting report from the Financial Times today. I think mostly because, if you recall, about a month ago, Donald Trump actually invited Xi Jinping himself to his inauguration. It's not likely, it seems, that Xi Jinping will actually go. I think there's probably a bit too much risk involved with Xi going to America and listening to Trump during his inauguration speech, particularly because Trump has a habit of kind of going off script, could really criticize China. Not sure that, the president of China wants to be sitting there in front of something like that. But just the fact that they're thinking about sending a high-level delegation kind of indicates that maybe China's taking that invitation seriously, even if it's not Xi Jinping himself. It's normally the ambassador to the U.S. from China that attends these inauguration events. So even if it's, something like Foreign Minister Wang Yi who's attending the inauguration instead, does indicate that China wants to take this relationship incredibly seriously and is interested in restarting this dialogue with this incoming Trump administration.
Bloomberg News Desk editor Jill Dasis there with the latest on some of those sort of geopolitical moves that we're watching at the moment. Welcome back. You're watching Insight, and as we continue to see that weakness when it comes to emerging market assets, in particular stocks, of course, seeing that correction territory. This is the picture when it comes to the rupee. Not much of a move, certainly not in the way of dollar strength at the moment, but there are sort of ongoing building expectations that the rupee will extend that slide from a record low in the near term. If you take a look at the options market, that's signaling a significant chance that the rupee will actually weaken to 87 to the dollar by the end of March. So a nearly 60% likelihood of the rupee falling to that level. That compares, if you take a look at just 9% of it recovering to 84 during the same 3-month period. So clearly there's a lot of investors at the moment that see that softer rupee in the short to medium term. A lot of that, it aligns with expectations of broader dollar strength, and it's not just, of course, an Indian rupee story, but broadly across emerging and Asian currencies. Well, Indian IT giant Tata Consultancy Services has reported quarterly earnings that missed analyst estimates for revenue and net income. It is a signal that overseas clients are remaining cautious. Joining us exclusively now is Krithivasan, who's the CEO and Managing Director at TCS. Really great to chat with you again. And revenue for TCS on a year-on-year basis was just about 5%. So clearly we're sort of still in the middle of that recovery and quite muted. Can you sort of characterise where you see this stage of the recovery and when we could see a bit more optimism?
Yeah. So I'll first come back, talk about where the optimism comes from, and then I'll talk about where the recovery is happening. We had a very good order booking this quarter, and the order booking was all across across geography segments and as well as industry segments. And also the pipeline continues to remain strong. And the early discussions that we've been having with our customers indicate that the budgets for next year would have a positive upward bias. So they make a flattish with an upward bias. So all these things on one hand give us the optimism that there could be that the recovery would be there. The second is where you asked about where what kind of programs or projects would be initiated that would or what kind of work would be done. We find that in three areas. One is technology modernization has not happened in many organizations for a few years. So there is the technology debt that's built up, and we expect many of the enterprises to spend in technology modernization. The second is cloud adoption. Many data points reveal that cloud adoption has happened only to 20 to 30% of the overall potential. So there is a lot more to be done, and so that may pick up speed. And the third area is as enterprises try to leverage generative AI, they also need to get their internal data structure, data organization right. So many of them are spending on remediating their data estate. So these three broad levers are the areas where we see new order bookings and customers' discretionary spend coming back.
You do sound broadly like you still believe 2025 will be better than the previous year. How confident are you? And I guess when you take a look at the bright spots for growth, where are they, and where are perhaps some of the geographic markets that are going to continue to be more challenging this year?
From a bright spot perspective, particularly banking financial services in North America has done well and is showing promise for us. And similarly, retail segment is also doing quite well. The area that we would probably watch out for is life sciences and healthcare, where we need to see the new regulations or policy around healthcare as the new US administration comes in. That would impact a lot on how much of new discretionary spend happens in the life sciences and healthcare. But we are quite optimistic on banking as well as retail segment.
North America really was a drag in the most recent numbers. Do you kind of glean as to why when it comes to what clients are telling you about their spending and their budget plans? Did the Fed cut not help? And does the sort of uncertainty over the monetary policy landscape this year potentially create even more of a drag?
See, in the last quarter, the North America was a drag because of a couple of reasons. One is a seasonally weak quarter. And we also experience seasonal furloughs in some of our clients. So the number of working days or billable hours comes down in Q3. And also there was a continuing macro uncertainty because the new government is still not in place. But when we have a discussion with our clients, we hear that there is greater optimism in terms of new discretionary spend, particularly as I mentioned in programs or project industries like banking or retail. So that gives us optimism going forward.
TCS is a big beneficiary of the H-1B visas, and with the incoming Trump administration, that's expected to be up for contention again. Is that one of the risks that you might be worried about?
Not really, Heidi. If you look at the number of visas we apply every year under H-1B program, it varies between 3,000 to 4,000. Considering our overall size and size of the operation, what we have done in the last many years is more than 50% of our US workforce is drawn from the local market. Our dependence on H-1B program on an annual basis is very, very small. So we are not too worried about any regulation change in H-1B program.
If you take a look at sort of broader geopolitical and country-to-country challenges specifically, do you anticipate that 2025 and over the next few years there will be more challenges?
I'm hoping there would be less challenges from because so there is some optimism that's already we are seeing in UK with government spending likely to increase. And we also find there's a greater consumer confidence in UK compared to the past. And there are similar trends in many countries within Europe. There are definitely few hotspots that we need to wait and watch on what happens in Germany and France. But most of the other countries in Europe are also looking positive. So excepting few hotspots which we have to watch out for in Europe, we are quite optimistic on North America as well as UK. And some countries in Europe will watch out for. But broadly, if you look at our market, we are very strong in Nordics, we are very strong in Benelux. We are finding good strength, and there is a greater tendency to spend on discretionary programs in those markets. So on the whole, in Europe, we are quite confident.
The theme on AI continues to attract a lot of confidence, is obviously very compelling, and I wanted to get your thoughts on Satya Nadella of Microsoft talking about the bull case for investing in AI in India. If we'll take a listen.
And I'm really, really excited today to announce the single largest expansion we have ever done in India by putting $3 billion additional dollars to expand our Azure capacity. The India stack, the entrepreneurial energy in this country, and the demographics, both on the consumer and the business side, that is all getting into a virtuous cycle. So that's why we feel fantastic about bringing core compute capability for the next generation AI.
Krithi, does this speak to the momentum of investing in AI for you?
Definitely. We continue to, in fact, we've been investing on multiple ways. One, we believe that this technology can deliver greater goods to our customers as they deliver new products and services. And also from a software engineering perspective, improving productivity of software engineering. Over the last few quarters, we have trained almost 500,000 of our associates in generative AI at different levels. And we also seen a lot of early success. For instance, for one of our large global clients, we helped them in identifying molecules for cancer treatment using generative AI that accelerated the process of drug discovery significantly. So we find there are very interesting use cases that are emerging. The overall technology is becoming more and more mainstream. We invest through training our people. We invest through striking partnerships with many of our customers. We also look at the entire value chain of multiple industries and see where all generative AI can be deployed productively and develop those pilots and proof of concepts to our customers so that they can be deployed very quickly. So a lot of investment continues to happen.
Do you think AI deals are coming at the expense of other types of deals?
Not really, because what we find is AI in itself is generating interest in cloud, generating interest in data. So it in fact is creating more opportunities in other areas as well. And at this time, we are finding more deals in terms of creating new products, new services, solutions that did not exist, enhancing customer experience. We are not seeing cannibalizing the existing revenue as of now.
I wanted to get your view on broader markets because obviously after the highs of what we saw partly through last year, we're now seeing Indian equities and the broader stock market and the Indian rupee coming under increased pressure. Does that sort of have an influence when it comes to corporations' incremental spending from your point of view?
From a India perspective, I don't see there's a major impact because of the currency. There would be some impact, but we are not experiencing a major impact because of the currency, Heidi.
What about the broad sort of confidence factor of where the economy is at and some of that uncertainty? Do you think that weighs into spending plans for your clients?
Are you speaking specifically about India or globally?
About India.
See, India, like two aspects, right? One, our exposure to India is still, while India is a very important market for us, our exposure to India is not very high. But if you speak to the individual, both government as well as non-government enterprises, the confidence is still very high. And there are a lot of new IT investments planned by many of the large corporations. So while there are certain comments that coming up about the overall state of economy or uncertainty, but broadly, when I look at IT spending, we are not seeing any reduction in IT spending in the India enterprises.
I suppose it makes more sense to see that weakness coming from perhaps sort of European clients and some of the external economies where there is uncertainty and weakness at the moment, right? But I guess all of this also leads me into wondering about whether you'll be a bit more subdued when it comes to hiring, in a particular sense of graduate hiring. Do you think that will kind of stay the same this year, or will that be more muted?
At this time, actually, our campus recruitment, what we are planning next year, will be higher than what we did in the current year. Normally, we hire about 40,000 associates from campus every year. And we expect to hire a slightly bigger number in CY25 compared to CY24. So from a campus hiring perspective, we are more optimistic on the number of new recruits we'll be taking.
Krithi, before I let you go, there's a great deal of uncertainty as we head into 2025, right? What do you think is the biggest risk that sort of you're most concerned about right now?
So definitely, you mentioned about geopolitics, right? Any major supply chain disruption that can have, for instance, manufacturing aerospace industry is coming out of labor unrest and some amount of supply chain disruption. But any resumption or any further disruption in supply chain can impact the aerospace and manufacturing industry significantly. So to me, any disruption in geopolitics is the biggest story I have at this time.
Really great to chat with you. Again, we appreciate your time. Krithivasan, who's the CEO and the MD at Tata Consultancy Services. We do have some breaking news that's crossing the Bloomberg for the development when it comes to the Seven & I management buyout situation. We're hearing now that Apollo Global Management is considering taking a substantial stake in a bid by Seven & I's founding Ito family to take the convenience store operator private. This is according to people familiar with the matter. We're hearing that Apollo Global Management is now discussing a commitment of as much as 1.5 trillion yen, or about $9.5 billion from an equity stake in the plan. The information isn't public according to these sources yet. According to the current proposal, Apollo would then join the Ito family and Itochu Corporation, which obviously is the operator of Family Mart in Japan, as key investors. The Ito family is weighing a commitment of around 500 billion yen. Itochu is looking at over 1 trillion yen. There are also other partners that are potentially negotiating that as well. That valuation of the buyout effort was originally planned for 9 trillion yen, but that could be lowered as the market value for Seven & I remains well below those proposals as well. So this was really seen even at that 9 trillion yen, trumping the 7.5 trillion yen takeover bid from Alimentation Couche-Tard, but we could see still that change. Apollo has declined to comment for now, but we continue to watch out for sort of potential confirmation. But of course, this consortium is racing to finalise that deal ahead of Couche-Tard. Take a look at what we're watching when it comes to the start of trading in India, and this is picture as we head into just the first few minutes or so of trading there. And the broader Sensex, we are looking at potential further weakness there as we head into the trading session. Slower growth expectations, in particular, a major headwind for that stock market in 2025. We're seeing a little bit of sort of upside at the moment, 0.25% higher. Banks, though, the biggest laggard at the moment, off by about 0.25% there as well. That weak economy, some of those significant challenges when it comes to third quarter corporate earnings are well short of expectations. Does that deceleration of confidence and business investment will be compounding the issue potentially for that equities outlook in India? Coming up next, a false evacuation alarm rattles 10 million residents of Los Angeles County as the region endures now a third day of catastrophic fires. A live update is next. This is Bloomberg. We do have some breaking news just crossing the Bloomberg in terms of some pretty high-level personnel changes within the Chinese government. China has removed Li Fei as the MOFCOM Vice Minister. We've also seen that Wang Hui has stepped down from the post of Deputy Housing Minister. The Ministry of Human Resources and Social Security making that announcement in a statement. In an additional change, the Deputy Chief of the State Administration of Foreign Exchange, Zheng Wei, is also no longer in that role as well. So a few changes being announced. There was no cause or reason being mentioned in that statement. Of course, we continue to focus on Xi Jinping's ongoing anti-corruption and anti-graft purge as well, being made mention of in recent speeches as still being really an unceasing endeavour and a key challenge, an ongoing priority for President Xi, saying that they will deepen that anti-corruption drive. We don't know if this is related to these individuals and them stepping down and being removed, but we know that there are now changes at the Ministry of Commerce, at the Chief FX Regulator, as well as the State Administration of Foreign Exchange being affected there. Well, President Biden says the US government will cover 100% of the costs of the California wildfires for 180 days, calling the devastation catastrophic.
So today I'm announcing that the federal government will cover 100% of the cost for 180 days. This is going to pay for things like debris and hazard material removal, temporary shelters, first responders' salaries, and all necessary measures to protect life and property.
Our Los Angeles Bureau Chief, John Gittleson, joins us now. And John, really great to have you with us, because I know there are sort of ongoing challenges even for you and your family in terms of these evacuation orders and the danger. What can you tell us about the latest?
Well, the latest is a new fire broke out north of Los Angeles this afternoon, and it swelled from 50 to 1,000 acres in really like in about an hour. And so these fires are popping up all over the place. Still lack of containment. A few of them, they got under control. I live in Hollywood, and last night we were ordered to evacuate our home because the fire could be the one you're showing, because they were able to drop retardant and water from the helicopters. They got it under control very quickly. Yeah, that's the one by our house. Anyway, we were able to return this morning because they got it under control, surrounded it, and put it out. But then new fires are breaking out all over the place.
So it doesn't feel like there's much of a hope that the tide is turning just yet. What are some of the challenges in terms of being able to get on top of what firefighters are fighting at this moment? I know that there's been concerns over a lack of sufficient water, for example.
Well, I mean, the biggest problem water-wise is the fact that it hasn't rained in 8 months, and usually January is the wet season, and so it's just been drying out, and one little spark can set this very dry, hinder, brush-covered hillsides on fire. And then the other factor was like massive winds. The trouble was when they had the massive winds, they couldn't attack the fires from the air, and so they only had hoses on the ground, and they essentially used up all their water in some places trying to fight the fire. They couldn't pump water up to the top of the big tanks that they have on hillsides to fight fires in order to, fill up fire hydrants and fight the front lines of these fires.
One of the really perplexing and horrifying things watching this is, here in Australia it's supposed to be our fire season, right? It shouldn't be wildfire season in LA, but are we talking about, as a result of climate change, a situation where there's no such thing as fire season and risk being contained to a certain number of months seasonally?
Well, this year is certainly like that. Governor Newsom said it's not fire season, it's fire year round. And yeah, that's definitely a problem. The people who run the, city's infrastructure, the Department of Water and Power, they'd say we need to rethink things for new climate resiliency because the climate is changing and that's make it harder to, be protected against these things. They need to figure out where to build and what kind of places to build. And when they rebuild Pacific Palisades, which was all these places actually around LA, they'll probably rebuild them, but they're going to have to think about how they design them to be better to defend.
Our Los Angeles Bureau Chief John Gittleson there with the latest, and you can also turn to Bloomberg for more on this story. You can get to TLIV Go to get commentary and analysis from our team of expert editors. Let's take a look at what we're watching when it comes to how markets are trading at the moment. And it is really that muted sentiment, right, as we get into the next session in the US, which gives us those key US jobs numbers. It's also quite a lack of confidence there after the PBOC kind of shocked markets by halting bond buying to defend the currency. But that is just about it for Insight. Horizons, Middle East and Africa is next. This is Bloomberg.